All right, so I want to welcome everyone to our day 3, session 3, our last session for day number 3. If you're watching the recording, excellent. Welcome to the final session for today. If you're watching on YouTube, we're actually posting these on YouTube this time, the recordings, which we've never done before. So if you are watching on YouTube, you say, well, I'm watching on YouTube. Why in the world would I want to go register for the event? Well, a couple reasons. One, you get notified when we go live and do the live session, and you can participate live. Additionally, if you didn't already know, we are doing giveaways. First time ever we've done giveaways, as far as I know, during an event, and we are giving away software and different products that we have. We've done 2 already. We're doing another one today. And but you got to be registered and you got to show up live and participate in order to do that. All right. Get over to my presentation. So my presentation is called How to Get Consistent Returns Trading Forex, even if you've tried and failed in any market before. And you don't have to be right all the time or have a massive trading account to do it. Just a disclaimer here, because we're going to talk about performance, we're going to talk about numbers. Basically says, don't want to get in trouble by the old government. So the US government, and probably your own government too, basically says anything that you trade is risky. We're not recommending you do anything, buy, sell, hold. None of that. Whatever you do is your responsibility. You are responsible for your own outcome, good, bad, or otherwise, okay? As long as we all understand that, we can go ahead and move on. You've been warned. All right. So why did you want to become a trader? I want to take a step back here in the beginning of my presentation. And we talked about a lot of stuff, a lot of things about trading, how to trade, what to do, psychology. My job in this presentation is to kind of wrap it all up together, review what we've done so far, and show you why it's important for your performance, whether that's finally becoming profitable at trading or remaining profitable at trading. We're going to cover everything, wrap it all together, and show you why it's all critically important, everything that we've told you and shown you so far this week, in order for you to be successful at trading. So I want to back up for a second because we've got some newer people in the room. I had actually taken this whole part out of my presentation like a couple days ago, and then I was watching the room. I was watching what the comments were, and I said, nope, got to put it back in. So we're going to do it anyway. What were your dreams, right? Why did you want to become a trader? Probably financial freedom is one of them. Maybe time freedom. That's a good one. How do you get time freedom? Well, you need financial freedom, right? Maybe you want to help your family, those who you know. Maybe you also want to be philanthropic, help those you don't know. You have more wealth, more money, you can spend more time to help others. If you can't even help yourself, it's going to be hard for you to help others, at least on a big scale. Of course, you can do small things for those people that you know, but on a big scale, you're going to have a hard time, maybe creating a foundation or starting a charity, whatever those things might be for you, whatever your big goals, your big dreams are. I want you to think about those right now. Now, unfortunately, the reality is that 90% of traders lose 90% of their account in the first 90 days of trading live. We call this the 90-90-90 rule, which is the majority of all traders. Think about it. How many successful traders do you know? If I put 10 traders in a room with a 90% success rate, that literally means that only one of you is going to really be successful, and at the most, or at the least kind of good outcome that they might have is that they're not just going to blow their account. They're going to remain at least even, break even, not really lose any money. Okay? That unfortunately is how bad it is. Now, we're going to talk about why that is, so keep that in mind. Think about this. How much money have you lost? Now, if you haven't lost any money, imagine what this would be like if you had. Maybe 5,000, 10, 20, 50, maybe 100,000 or more. I've talked to multiple traders on the phone back in the day when we used to do trader assessments on the phone, and they had lost over $100,000. It was literally their life savings. And I said to them, did you ever think it was time to stop? Did you ever think it was time to stop trading? I don't know what I'm doing. Put the money aside and actually learn how to do this. Learn the skill. Fix your psychology, whatever it is, or probably all of the above. And they said, well, no. And unfortunately, that's the case for many traders. And you may not have lost 100,000, but you may have put in 1,000, another 1,000, another 2,000, 500, another 500, etc. And unfortunately, this is what most people do. They think if they just throw more money at it, they'll get it right. What I want to do is talk about all the problems that are preventing you from being successful. Again, we're wrapping up everything we've done thus so far and putting it in a nice, pretty single presentation. Are you a victim of the free content trap? What does that mean? Now, you might find this ironic, but these are Google searches from, a couple years ago. I'm sure it's worse by now. Forex, technical analysis, financial trading, all returned in under almost half a second. Okay? So here's the deal. If this is all you needed was more free training, so many traders say, well, all I really need is more free training. I would say, well, if all you needed was more, I don't know why this isn't enough. then why is there a 90% failure rate? There is so much information out there. You can spend days, weeks, months, years down in the YouTube trenches or the Google trenches and the forums and so on, and never be successful. Give me a yes if you've done that. Give me a yes in the chat, please, if you've done that. Say aye. Want to know what we've gotten here? Yes, yes, yep, yes. Now, if you haven't, great. Don't start. You might say, well, this seems kind of ironic. Isn't this a free event? Yes, it is. I do understand that. The point is, you cannot spend forever, in the free trenches. You've got to get out there, find a process. You can't just consume knowledge and strategy and technique after technique. I want to talk more about that. And expect to be successful. It's not going to work. There's plenty of knowledge, but there's a failure rate. So you got to figure out what's the problem, what's the disconnect, and I'm going to help you guys understand what that is today. Are you a victim of random actions? Now, Jason already did a slide like this. Some of you are like, get out of my computer. That's my screen. Why are you hacking me? My chart used to look like this, full of indicators, full of all kinds of stuff. I didn't know what to do. Buy here, sell there, buy there, sell here. Nothing was the same. Every single trade I took was different. How many of you can relate to this? Give me a yes in the chat. If you're watching the recording, raise your hand to the screen, right? This happens. Now, are indicators bad? No, but this is what most traders do. They slap a bunch of indicators on there that they learned how to use, air quotes, and then just go at the markets and think that's going to be the way to go. Or they're going to learn a bunch of techniques. They're just going to use one after the other, and it's going to work. Fortunately, that's not how it works. All right, the next one. This is my favorite one. Are you a victim of the real money myth? This is the worst one, though, unfortunately. People say, but Charles, I need to use real money or I'm not learning to trade. Well, you are learning to trade. You're learning how to lose money, okay? When you push the buy and sell buttons, that's you, right? You're pushing the buttons. A monkey can push buttons. You're not guaranteed any money comes out the other side, right? It's just not going to happen. You're not a guarantee because you push a button. One trader was commenting in the chat, and that's why I decided to put this section back in. Like, well, I'm trading and I'm doing it, and I'm trying to trade a lot. I'm like, listen, frequency is not the guarantee of success. It's about the decisions you make, right? Why do you push the buy and sell buttons? When do you push the buy and sell buttons? It's very important. So to sum it all up, the majority of traders say, I want to trade, which is awesome. But they watch videos and do research, which is a good start. You got to start somewhere. Do you even want to do this trading thing? Maybe you don't want to. I don't know. They try trades and demo if we're lucky. Or we might skip to just fund a live account. We lose, blow up the account. We realize we're not successful. And what do? We go get mentored. We go get help. Oh, wait, that's not what happens. We seek the breakthrough and we do it all over again. Okay? And we do it all over again. Now, for some of you here, you're probably afraid of failing again or for the first time. You worry your family will think you're gambling. You worry that you'll blow another or your first account. You worry that nobody wins in the markets. You worry that everyone teaching is a scammer and lying to you. You're sick of gurus flashing their fake success in your face. You think you have to be smart or study finance to be a successful trader. You think you have to make massive returns or always be right to be successful. Now, we dispelled a bunch of those myths already, but it's important to bring them up again because, I can see some traders are still struggling with this. Now, this is the majority of traders. This is what they see, and they just gravitate towards it. Look at these ads. See how a shockingly accurate Forex rollback skyrocketed my Forex earnings to over $2.4 million while I kicked back and did nothing? Shut up and take my money, right? Easy cash, broken slot machine, easy money, no trading experience whatsoever. The Forex never lost auto robot. Make money while you sleep. Buy my course that teaches you nothing useful. Turn 100 into 1 million in just 30 days. Never lose another trade again, right? How many of you have seen anything like this? Give me a yes in the chat if you've seen these ads or anything similar to it, or YouTube videos with all those gurus with their fake cess. Exactly, we've all seen them. And they're preying on you. You've got to understand that. The truth is, the failures you've had aren't necessarily your fault. Nobody told you how hard it would be, and based on the last slide, that's actually the opposite of what they did. In fact, most people have lied to you and sold you a bunch of garbage, as you've probably already realized. Now, today, what I'm going to do in my presentation is help two types of traders. As a beginner, you will understand how consistent returns are made in just about any market, if you don't already know that by now. And as a more experienced trader, you will get the missing pieces and path you need to get consistent profits in Forex, at least, which is our focus at Tier 1, which is what we trade out of mostly. Now, you can apply these things to any market. It's not going to matter, but we do focus on Forex. So for the next 60 minutes or so, my goal is to get you to believe that backtested, profitable trade plans are the key to consistent returns in Forex or any market for that matter, And I'm going to show you the frameworks that will give you the greatest chance of creating one of those for yourself. Sound good? Now, we've already given you guys a lot of tools and things to do, and we've covered trade plans a bit. All right, but we're going to put this all together. Okay? So the first questions traders ask me are, how in the world do you create a backtested profitable trade plan? And do I really need one to get consistent profits in the financial markets? Now, in order for me to answer those questions, I have to tell you how it began for me, because it's going to lead right into why this is important. Now, I won't spend too much time on this, try to go as quick as possible because nobody likes these stories. But here's my story. In the past 10 years, I've evaluated many different ways to trade. I've helped thousands of traders in over 100 countries, which we've all done here at Tier 1. I've shown them how repeatable processes are the key to consistent profits, which is achieved by creating a backtested profitable trade plan. Now, it wasn't always this way. Fortunately, I struggled to create a consistent process, which means I struggled to make consistent profits. Remember that. We're going to bring that up later. Consistent process equals consistent profits. I struggled with too much information, the free information trap. I struggled with knowing what I should be learning so that I could be successful. Instead of wasting time, what was it I should have been learning? Well, how did it start for me? I was at an IT job. I hated it. That was what I went to school for. I thought it was great, into computers. It was probably a good idea. But I didn't like my job. I didn't like the company I worked for. I had to work up the corporate ladder to spend my life doing that. I don't know. I just wanted more freedom. Even if I got paid less than what I was getting paid at my job, it would be okay because I wanted more freedom. Who would like that? Give me a yes if you would give up a little bit of that income security for more freedom. All right, good. Because when you first start trading, you're not going to be trading a couple $100,000 account and just making all the money you need to live, right? You got to start kind of with your job and your trading. Okay, that's important. Now, I wanted to escape. Like I said, I wanted to find another way to make money, have more freedom. Our department has had tickets to one of those business events, they have at the arenas. And I heard an inspired speaker talk about the markets and trading, and I thought that this was my way out. Now, my ultimate goal was to have more time freedom, like I said, to spend time with my wife and our future family, our 2 girls that we now have. And I had no idea that this desire would require me to change as a person. Okay, as the saying goes, it's easier said than done. You will have to change. I think some of you are realizing that already throughout this week. How would I have to transform? I would need trading skills, and I would need solid discipline or trading psychology. I would need to believe in my process to remove the doubt and insecurity in my trading. Ultimately, what I needed was a consistent process that generated consistent profits that I believed in. Who here believes that that's what they need? Consistent process to generate consistent profits that they believe in. Give me yes if you believe that that's how this works. All right, good. Very good. Good. So what did I learn from this? Well, I tried penny stocks and failed. I blew my parents' trading account using an option signal service and failed. It did well. I didn't. It did very well. I did horribly. So there's an example of following signals without having solid trading psychology. Then I ended up trying a few strategies here and there and failed. I was unconsciously incompetent, which means I didn't know how bad I really was. We're going to talk more about that in a minute. Okay? I was at the unconscious incompetence stage. I was naive. I was ignorant to how dumb I really was in trading. So what did I learn? Well, I learned that never trade money that you cannot afford to lose. Drawdowns are normal. You will have periods of winning and periods of losing. Trade the plan or you'll incur more losses than is necessary. The real problem, listen to this, the real problem was me and lacking belief in my process to stay consistent. Okay? That was the ultimate problem. So what happened next? Well, I was now consciously incompetent. I'm aware of how bad I really am. I had too many failures. Now, for many of you, this is where you're at right now, and that's why you're here. So is that why you're here? Because you realize that you need help? Give me yes if that's you. If you realize, yep, that's why I came to this event. I realize I don't know what I'm doing, and I'm here to fix it. Awesome. So I decided to put in the hard work and create a method for myself, which is something that we've been preaching for the entire week so far. Something that I could believe in, right? So I could hand one of you a trading plan, but if you don't believe in it, what does it matter? One of our traders was commenting that, one of our attendees in the chat. Well, I take the trades, I have a process, but I end up messing up, right? So this was a good plan, but unfortunately the worst was yet to come. I knew the problem was me and the lack of belief in the trades I was taking. I read books, watched videos, attended webinars, the free content trap for a bit, ended up learning a mountain of techniques and tactics, right? Techniques and tactics, a whole list. But all I had was a jumbled mess. How many of you can relate to that? A jumbled mess of techniques, tactics, and different strategies that you trade all of them at the same time, right? Let me do this one now. I'm going to do this one next. Then I'm going to do that one and this one and that one, right? Yeah, lots of poor habits indeed. So every time I placed a trade, it was different than before. You guys can relate to that. I was picking and choosing random skills each time I went to the charts. The result? Well, we know what the result is. Less belief, more doubt, and the exact opposite of what I set out to achieve, right? Then the worst thing I told you about happened. Anyone guess what it is? Dun, da, da, da. I blew my entire account. Shocker, I know, right? Completely. No one saw that coming, not even Nostradamus. It was not enough to attempt to create a process. I actually needed a repeatable process that had a proven track record, something I could believe in when it came time to trade, something I created, and that I could be consistent with. So I still believed I could do it, right? I knew the problem was still me, so I decided to give it one more try, and that means for all of you here who are struggling, there is still hope for you. Some of you were very frustrated and realizing that you're not doing these things right, and you're listening to what we're saying throughout the week, and you're like, I'm just never going to be successful. One of the traders in the room was putting those comments in the chat. Okay, there is still hope, but you've got to do things correctly, okay? So what held me back? Well, I thought I could bounce from method to method, system to system, signals and techniques, right? We talked about that. I thought I could put it all together and call it a trade plan. Wrong, right? We know that by now. I thought I could do whatever someone says, signal service, and somehow have belief to execute consistently. That didn't work. Shocker again. We know none of this worked by now. I was at my wit's end, but there had to be a way, all right? There could be thousands of combinations of trying to find my own process. It could take years. I wondered, was there a way without wasting valuable time waiting for market data every day? I could spend all that time and come up with nothing if I had to wait for the market data every day and end up right where I started, a failure. We were about to have our first child, so this was do or die for me. Literally no going back. I had to make it work, right? So here's how things finally changed for the better for me. One day I stumbled across a video during one of my many binge sessions, which we're all familiar with, and a guy was talking about a simple strategy that he developed. Now by this time I knew better, my bells and whistles, my ears were up. I'm like, whoa, simple strategy, hang on a minute. But then he said something that I didn't expect. He said the real reason you're not successful isn't the strategy itself, right? It's not necessarily the strategy itself. Instead of looking externally for something new, you've realized there's something that you need to be doing internally instead. Amazing. This is exactly what I had been dealing with. Give me a yes if you guys are at that point in your trading. You're like, yep, it's me, right? It's me. The problem was me, not the strategies or the methods. It was clear this guy had been where I was, which means that there was a way out, which is good, right? Imagine knowing exactly where and when you're getting in, exactly where your protective stops go, exactly where your targets go, and letting the trade play out because you believe in the process. And we've demonstrated that throughout the week so far. Now, why? Why would you believe? Because you believe in the long-term outcome of your actions. That's why. That's why you would let the trade alone, right? Put it on, walk away almost, right? You just let it go. Let it play out because you believe in the long-term outcome of those actions. Another key word he mentioned was testing, which of course we know is making sure your strategy works before trading real money. That way you stay consistent when things become emotional or losses come. So I wondered, did he have a way to shortcut the time of live demo trading? Again, I didn't want to waste too much time. I didn't have a lot of time. I went on to watch more videos of this guy, and then he said something else. He used the word backtesting, which we've discussed this week so far. Some of you may not have been here. So what is backtesting, you ask? Well, it's just like live demo trading and testing. It also has the same purpose of verifying your method should be profitable when trading live, except it's done on historical charts. This will cut months or years off the process. I could test as much and as fast as I wanted. For me, this was a new opportunity that I had been waiting for, which are backtested, profitable trade plans. So the new plan was this. I learned the skills I needed, learn the process of using the skills in a plan, then I would learn how to backtest it for profitability, make it my own, and then trade live capital. Since then, everyone here uses the same foundational principles here at Tier 1. We're pushing the envelope and giving our community the greatest chance of success to create their own backtested profitable trade plans, and that's exactly what this entire event is about. Taking up teaching, for me, actually helped me become a better trader. It accelerated my learning process by forcing me to be able to show others how to do it. Becoming a mentor, getting into our students' minds to help them is critical as well. Plus, it feels really good to help others. All right, so here's the 3 keys we're going to cover today. First one is how to create a backtested profitable trade plan without wasting years of your life. I'm going to call this the master key. Now, we have discussed trade plans already this week, but I need to do this again. I call it a master key because there's 2 other things that are part of your trade plan, but they're very important, so we're going to separate them out and discuss them individually. The next one is how to make more profits by being wrong more than you're right. That's right, more profits by being wrong more than you're right, which is the sub-key of the master key. It's part of your process. And the third key that we're going to discuss is how to almost double your profits without changing your trading strategy. Another sub-key of the master key, which is your trading plan. Cool? All right, time to take out your pen and your notepad. Everybody ready? Give me yes if you are ready to dive in. Very good. Love the interaction. You guys are awesome. Okay, so key number 1 is how to create a backtested profitable trade plan without wasting years of your life. Now, these are guidelines, as you guys already know. You can customize as needed, but we will cover the primary building blocks, which again is what we've been discussing throughout this entire event. I have never, I repeat, never seen a trader able to create a plan, test it, and stay consistent without these 3, count them, 1, 2, 3, primary sections of a trade plan. Okay, so I'm going to give them to you. We did discuss them in brief. Jason did, but we're going to get into the nitty gritty here. Okay, I'm going to slow down a bit so everyone can take notes. All right, we're going to slow the pace down for a minute. Want to get through all that busy work in the beginning and get right to the good stuff. Section 1 is your pre-market and personal routine. Okay, what I'm going to do here, we're going to discuss, we're going to go through each piece of the section, and then we're going to talk about why it's important. And the next ones will go back and forth. Okay, first one. What do you do before you hit the charts? Do you have any mind preparation that you do? Do you review any news events so you're prepared, not necessarily to trade them, but prepared that they might be coming? So if you have trades on or you're going to be taking trades, maybe you have to avoid that news event. Who knows? Depends on your rules, right? And your pre-market analysis. What are you doing before you actually kind of get into trading? I do say hit the charts. Pre-market analysis is obviously on the charts, right? What are you doing before you're actually supposed to start placing trades? Your trading window, if you will. In your trade plan, you will have a trading window. Times where you will trade, times where you will not, based on your testing. What time did you go to bed that night? That could be important. What is your diet like? What is your exercise routine? Do you get out and do some exercise? You walk, run, gym, whatever. Maybe you're too emotional to trade today. This is a big one. How many of you really identify with the last one? That you felt horribly in your emotions, right, in your mind, and you went ahead and traded anyway. Give me a yes if you've done that. You felt horrible emotionally, but you traded anyway. Give me a yes. All right, for those of you that said yes, how did it go? Good or bad? Bad? See, lots of bads. Bad, 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 bad. Very bad, not good. No coincidence, right? So why are these important? I think you probably know, but let's discuss it. Your success depends on the quality of your decisions, not just the decisions themselves. As we've already said, when Trader was talking about frequency of trading and not the number of decisions you make, but the quality of those decisions. Frequency does not equal success in trading. It's not like if I work more hours, I get paid more. That is not how this works at all. Okay, this is a rewards-based endeavor. Good decisions, returns, okay? So if you're not ready, right, it's going to be a problem. If you're too emotional, unprepared, or unhealthy, how good do you think your decisions will be? Listen, you're the one making the decisions, right? You're the one pushing the buy and sell buttons on the keyboard or on the screen. If you are not at your best, you are going to have trouble, right? This is so much more about you, right, about the trader, than it is about all the skills you can learn. Remember in the beginning, I told you I would have to change a lot as a person to be successful. You will too, okay? If you haven't already realized that by now, this is the light bulb moment. Ta-da! Okay, you realize by now. You better. If you don't, I don't know. All right, hopefully you do. You will have to change. Whatever you're doing is not working. We're going to talk more about that as we go. This journey is an internal one more than an external one. I've already said it, but it's absolutely true. So you notice that this pre-market and personal routine hardly has anything to do with the charts. Did you notice that? Just a little bit of pre-market analysis in there, kind of threw it in because it depends on what your routine might be. But the majority of all of this has nothing to do with trading. Nothing. Not a thing. It has to do with you. Are you in the optimal state of mind, being whatever, to come to the charts and trade? Now, in the beginning, these things will be hard. And at some point, you'll settle into routine. You'll be good to go. All right, everybody good with section 1? Give me a yes if you're ready to move on. If you missed something, we can go to the recording later, so don't worry. All right, just want to make sure the pace is good. Okay, section 2. This is your market analysis routine. Okay, this is going to be part of your plan where you're going to have to actually do market analysis, kind of the pre-market analysis, I guess, and any other analysis that you will do during the trading session. Now, if you're actively day trading, there's going to be a few hours in the morning, whether London or New York or Asia. If you're swing trading or doing daily bars, right, you're going to be doing it once at the end of the day. If you're swing trading, kind of intra-swing day trading, it can be any time throughout about 8 hours or so, depending on what your backtesting results tell you. Step 1, determine the market direction. You must know what direction the market is going, so whether you are going to pick your trade direction, whether that's trend or counter trend. And I would say pick one when starting out. Pick your favorite. If the market is careening up, massive bullish candles one after the other, it's going higher, and you got to jump in and sell that market because you've got a qualified trading setup. If that turns your stomach and you're like about to get nauseous, me just talking about it, you probably don't want to be a counter trend trader, right? You probably don't want to do counter trend trading or consolidation type trading where the market goes up and it goes down and you buy and you sell at different points and you're always going kind of against the current move. That's probably not a good idea. And then maybe you're the opposite, okay? Maybe you're the opposite. You're like, trend, I'm a pessimist. I'm going to be counter to that thing all day as long as I have qualified trading signals, right? I like to be a contrarian. If that's you, then you should be a counter trend trader to start, right? And maybe you'll never change your trading style. That's fine. But you need to be able to pick a trade direction so that way you are on the right side of the market. Make sense? All right. Step 2, determine areas of interest. Where will you look to get involved in the trades? So we know what direction the market's going. We know where we need to get involved. If that's trend, there's going to be continuation zones, right? Or retracements in the market. You might look for support resistance in addition to that to help have confluence, right? And look for those opportunities to give you the best risk reward and the greatest opportunity of winning. If you're a counter trend trader, you might look at reversal areas as well as support resistance zones, okay? So we got market direction. We need to know which way we're going to be trading in the market. We know which way our plan is. Now we have to know what's the market doing so I am in the right position. And maybe I have to sit on my hands, right? Then we determine areas of interest. Where am I looking for opportunities? Where are the best places for me to look? Then you have to determine entry timing. Okay, now some of these can kind of be lumped together, right? But we'll see the more or less the steps that you need to take. Determine entry timing. Is there some other thing that you will use, an indicator or price action to determine timing? So here's my area, here's my trend, here's my market direction. I know what I need to do, depending on what kind of trader I am. Here's my area of interest that I'm looking at. And then here's my entry timing. Am I going to wait for something before I'm going to look for my entry signal? Maybe my entry signal is the timing. You can see how some of these things can be lumped together depending on your testing, your results, what you've found in your testing through your plan. Okay. Step 4, determine your stop and target location. Okay. Entry stops and targets, entry stops and targets, entry stops and targets, EST. We've been hammering it in throughout the entire event. You must know these before you begin to trade or take a trade. This is to be dependent on your risk reward requirements, whether it's trend or counter trend maybe, the capital risk requirements as well. So we'll get more into like risk reward and how that works in leverage markets like Forex. Because it's a little bit different than like stocks where the money is equivalent. Okay, a little bit different. We'll talk about that. Okay, but depending on all these things, you have to determine your stop and targets locations. Where's my stop going to go? Where my target's going to go? And there's a bunch of factors here, of course, that go into that. I'll stop at the end. You guys make sure you've written everything down. Step 5 is wait for the entry technique. Okay? Now, determining entry timing, like I said, may be the entry technique, and that's fine. In which case, you would do step 4, 1, 2, 4, and then 3 and 5 would kind of be together. Again, it all depends. But in most cases, you're going to be doing it like this. This is the last thing we do. Literally the last thing. Everything is decided first. EST, entry stops and targets, and then we're going to manage the trade. All right. Is that clear to everyone? Give me a yes if that's clear, and we can move on. Now, Jason's already covered this, so there should be a bit of a review, but I want to kind of bullet point this out, and again, we're tying everything together because we're like in the middle of the week here. We're winding down the end of the week, the end of the event. Want to make sure, we're not done yet, of course, but we want to make sure that everything is coming together, and that's my goal here today, okay? All right, section 3, trade is on. What's our trade management routine? What are we going to do? Okay, what are we going to do? Will we leave the trade alone? Will we just put it on? We got stop, single target, done. Dusted and done. All done. Nothing to do. Wait for the trade to play out. No trade management. Now, this is the easiest way to manage the trade. This is great for single target, high time frame swing trading, or even day trading, whatever you want to do. But for most traders, you guys aren't going to be starting actively day trading for a couple hours during a morning session 3 or 4 times a week. That's hard to do. You have to know what you're doing. Okay, you have to be pretty seasoned. All right, it's better. Plus, many of you will have jobs. You're trying to get into trading, right? You need to work around your schedule. So you'll be doing like daily bars at the end of the day, or higher time frame swing trading like 4-hour charts or higher. Okay, but this is the easiest thing that you could do. You don't have to manage anything. Or will you manage your stop loss if trading multiple targets? Okay, of course, this is great for multi-target trades, swing or day trading, of course. This locks in profit and reduces risk. What do I mean? Well, if I have a entry and I have a stop and then I have 2 targets, we talked about this on a multi-target opportunities with Akil on the charts earlier today. Target 1, target 2 is farther. If I hit target 1, I move my stop loss, order to break even where I got in at my entry. Call it break even because you're moving it to the exact same price you got in at, or maybe plus 2 pips or ticks or whatever, or minus, depending on which. We just say plus, into profit to account for spreads and things like that. Now, are you guaranteed to get out at that stop loss price? No, because stop orders are market orders, but it does help lock in that profit, reduces risk on the remaining of the position. All right, so very good. So even if that second target hits very low percentage, your risk reward is already cut in half, especially if you have a decent percentage hit to your first target. Imagine your stop is at break even and you're just waiting for the trade to play out. 20% of the time it hits second target, 70% or 80% of the time it hits stop loss for like -2. And normally I get like, averages say plus 20 or whatever. It's pretty good, right? All right. Will you reduce risk through trail stops? Now, some traders were commenting throughout the week in the chat. I saw, well, why don't you trail stop? Why don't you put second target? How come you didn't do this? How come you didn't do that? What is this about, right? What do you want to do? Maybe you want to have a single target. Maybe you want multiple targets. Maybe you want to move stops to break even. Maybe you don't want to move stops to break even. Maybe you want your first target is to pay for the rest of the trade. For your second target, you don't move your stop loss. Or will you trail stops after first target and your second target is a trail stop? I don't know. It's endless what you can do. The question is, why don't you? Yeah, why not? Sure. Why don't you do that? Yes. Whatever you want. Right? Helps you lock in even more profit with multi-target trades. For trail stops, this is really for longer term trading or trend following trading, whether that's day trading, but probably not so likely, but you might, depending on how you want to lock in profit or what you want to do, what you think is going to work best. But for longer term trading, swing trading, higher time frame trading, trailing a stop can be really good, especially if you're looking for those long extended trend moves. Okay, counter trend, not so much. Counter trend, you're going to be looking at really single target, maybe multi-target with a moving stop loss to break even, just because the moves are not going to be typically that long, right? It's a quick move and then you're done. But for trend following or longer term trends, we're looking for long moves, right? And you're not going to hit your targets as often, but there's usually a lot more profit. And these are trade-offs, and we're going to see that as we go. Okay? Finally, how will you manage your money or position sizing of the trades? This is to take advantage of winning periods and reduce losses during losing periods. We're going to talk about this later as well. Okay, how will you manage your money? Now, risk reward in pips with a leverage market, we're going to talk about this, like I said, is very different than stocks where the money equivalent is the same to what you see on the chart. For leverage instruments, we need to separate these things out, and we'll see why. Okay? But money management is about taking advantage of a winning system, a winning trade plan. Money management, I repeat, will not make a losing trading plan profitable. If you cannot return ticks, pips, whatever in the markets for leverage instruments like this, Forex, futures, whatever, okay, if you cannot do that, money management will not save you. You have a losing system. You must be able to return the smallest increment that is consistent across the markets that you're trading. For example, Forex is pips, futures is ticks. It's the same thing. It's the smallest movement in price. But these are leverage instruments. Until you can get those out of the market, money management means nothing. Money management is the icing on the cake. It's the cherries on top. It's the decorations on the cake. Make sense? All right. Someone says move stops before major news maybe. Exactly, Stuart. See, you're getting it. You know. There's all kinds of reasons why you might want to be doing these things. If you can think of any others, of course, write them down. Are we good with section 3? Ready to move on? Give me yes, please, if you're ready. All right. Looks good. Now, you're probably thinking, how do you decide what to do? I'm sure some of you have been putting these comments in the chat throughout the week. What do I do? What do I do? I don't know. What do I do? How do I decide? Now, once you have the plan, okay, you go bar by bar on historical charts. You record the results in spreadsheets. You compare your results of different plans, methods, and markets. Make any strategy modifications that you need to. And then you decide on your final strategy method, the plan overall, and based on the results, what portfolio or markets you're going to trade. Then you set up a money management strategy. And once we've done all that, then we trade live. Do you see all the preparation work that goes into this before we put our money at risk? What's the point of trading anyway? The point of trading is to make a return, not to blow your money, right? So if you have no conceivable idea that anything you're doing will actually return a profit, you have no results, no numbers, no nothing to prove any of that to you with any reasonable amount of certainty. Again, nothing's guaranteed. It's about probabilities here. If you have none of that, why in the world would you trade real money? You wouldn't. It's stupid, right? It doesn't make any sense. So why is this process so important? Now this comes down to a comment one of the traders made in the chat this week. I think it was today. So you can have a consistent process that brings consistent profits. Again, consistent process brings consistent profits that you can be consistent with, right? And you must fall in love with this process, and here's why. This is very important. The commitment equation, I call it. Probably someone else thought this up, but this is what I call it. So I'm taking credit. We have commitment and disappointment graph here. There may be some curves, okay? You can draw them out if you want. Now, as we experience disappointment about something, our commitment level goes which way? Well, it goes down. The more disappointment we experienced as we increase to the right, our commitment level was high, and it's starting to wane, right? It's not so good anymore. I don't think I want to do this. I don't know. Nobody wins in trading. This is ridiculous, blah, 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 blah. Now, the other commitment equation we can have has to do with satisfaction, right? Now, if we experience a bunch of satisfaction wherever our commitment level was before, right, through the roof, to the moon, doggy coin to the moon, right? Our commitment level is going to go up if we experience satisfaction. Now, it can go one or two ways, right? Disappointment, lower commitment. Satisfaction, higher commitment. Let's expand upon this. How does this work? Well, expectation minus reality. Obviously, I don't know what numbers you'd give, but I'm just trying to illustrate the purpose, right? Expectation minus reality. If you get a positive number, I know this is weird, just bear with me for a second, you're going to get disappointment. Why? Because our expectations are often very high. We have high expectations, okay? I think of 100% I'm going to do this, and then reality sets in and you only achieve like 50%, you're left with 100 minus 50 is 50, that's a positive number, and you're disappointed, right? Because your expectation was super high, reality came in not so good, halfway, maybe even lower, and your disappointment is a positive number. It's bad. It's bad. It's huge, maybe. Maybe it's 100% and I came in at 20. Well, now I'm really demoralized. Now, if you come up with a negative number, so let's say our expectation is like 50. I think we get 50% of this right, done, correct. It's going to work, 50%. Reality is, whoa, I achieved 75. Well, that's a negative number. 50 minus 75 is a negative number. We have satisfaction. That's the reason these are in reverse. I know it's counterintuitive. I don't get it. Shouldn't satisfaction be positive? Yeah, I know. I get it. But expectations are typically too high. Reality is usually coming in lower. So I wanted to illustrate how we often perceive this thing so it makes sense. Everyone got this? We good? So let's put it together then. Who experienced disappointment and has their commitment go down? Well, that's 90% of failing traders. Why is that? Well, successful traders focus on the process. All right, successful traders are focused on the process. So instead of tying all of their satisfaction or disappointment to the outcome of the trades they take, which is what the 90% of failing traders do, the proper trader, it's like a tier one trader, focuses on, and all of you who are here focus on the process of doing better, improvement, doing the right things, getting better skills, getting further along in the process, and you experience satisfaction because you're like, hey, I'm learning this. Yeah, I get it now. Oh, light bulb here, light bulb there. Your commitment level goes up. And what have you tied it to? You've tied it to actual improvement, which is going to get you the outcome that you desire. But instead, you don't put the desire on, the outcome being the desire on profits. You're only going to experience disappointment because you don't know how to trade yet, right? It's so simple. I don't know how to trade, but I'm going to put all of my commitment level and all of my emotions onto whether or not I have good trades. And over time, I actually make money. But I don't actually know how to do that. And now I hate trading. Right? It doesn't make sense. Cool? All right. So let's review. You've created your plan. You've tested your plan. You believe in your plan. There's no guesswork. There's no random actions. Remember, this is mostly an internal and transformational process. Why is transformation necessary? And we've discussed it. Imagine you are a surgeon, okay? Human body are the markets, complex, like Forex, stocks, Bitcoin, futures, indices, I don't care. Surgery tools are your trading plan, okay? Market analysis, EST, entry stops and target placement, risk management, money management. The surgeon is you, the trader. Skills, charting and business skills, focus on commitment, your mental stability, your trading psychology, etc. Right? Now, the human body and the markets, they are complex, right? They're complicated. They're not terribly easy to understand, just like the human body is difficult to understand. You have to understand a lot of things to do a good job with it when you're in there meandering around, and your surgery tools are your trading plan. Now, hopefully you're using a scalpel on that human body, but some of you are using this thing. You're like, Og, and he's dragging his knuckles, and he's bringing this hammer and a rock, and he's going to go, I make pips, bang, like, this is not how it's going to work, right? This is not how this works. Now, the surgeon, you, the trader, might be really successful in your current career, in your life, but you approach trading like a bull in a china shop, right? Just not the right Thor. Well, he would just, blast everything and make pips, I guess. Right? You might be successful in your current area of life. So you think, I'm going to go trade. I'm going to be successful because I'm already a successful person. This is going to be easy. But you come at trading with like this giant hammer, which is only meant to smash things. Now, some of you, unfortunately, have two bad things going on for you. You have all the wrong things in your trading, and you come at this thing like, the caveman. Ugh. Me bash markets, me make pips, right? You come at this thing like a demo guy with a demo hammer on a construction site. This is the worst possible combination. It is not going to go well, right? I promise, not going to go well. So, markets are complex. We got it. Your trading plan needs to be a scalpel. But maybe I just handed you a trading plan, and we talked about this. But and it's profitable, right? I told you I followed a signal service, did super well. I tracked all the trades that they did, made money. Me? No, because I didn't do all the trades they took. I did those, then some, skipped others. So I was this guy. Now I could give you a trading plan, but you don't believe in it enough to be consistent. One of the traders in the room talked about this today. Okay, so it's not enough to just be handed everything. What do I need to backtest it if it's already profitable, Charles? I don't get it. Ugh, I make pips, right? You're still this guy. It's not working. You cannot be this person with even all the proper skills and the exact trading plan that makes, this much money. Even if I only gave it to, a couple traders so we didn't, have everyone using it and then it doesn't work anymore. You have to come at this the correct way. So the markets are complex. You need a good trading plan with the proper tools and the proper skill set and the proper mindset. That's you, right? Remember, you're the one pushing the buttons. It's all about you. If all you have is a hammer, every problem looks like a nail, right? We've heard that before. So that's why transformation is necessary. Now, we talked about this before, unconscious incompetence. This is where everybody starts. You do not know that you do not know what you're doing. We already discussed it. Then we discussed conscious incompetence. I'm bringing this up now because we just talked about all the changes that need to happen for you. You're probably here now. Most of you said that that's why you're here. You know that you do not know what you're doing. So we got these two down. Let's skip ahead to the next one's conscious competence. This is the path that we take our traders on at Tier 1. And we're trying to take you guys on, in brief, this week. You do know how to do something, but it takes a lot of focused effort. A lot. It's hard to do. You're like, I kind of get it. I'm pretty good. I got a plan, sort of, kind of not, maybe. I don't know. Where we want to get to. Or even if you're at the last stage where you're like, yep, I don't know what I'm doing. I am consciously incompetent. I know I don't know what I'm doing. Our job is to bring you from there forward. And then conscious competence. This is the ultimate destination that we all want to be at. And we want all of you to achieve, which is that you do not need much focused effort to execute. This is second nature. Everything about your trading becomes second nature. You have a plan. You know what it says, but you rarely look at it anymore because you know exactly what it says and what to do. But then something comes up, maybe you forgot, and you go to it anyway. And before you know it, you'll internalize everything. And all you have to do is kind of execute some actions and you're good to go. What is second nature? Let's illustrate it for a minute. Okay? Whoops, too far. You're driving down the road, and then all of a sudden, there's a light, and it's red. You weren't paying attention, but now you are. Slam on the brakes. Why did you do that? Right? Why did you do that? Well, because you saw a red light. What do I see? What does it mean? What do? I see a red light. That means I have to stop. I slam on my brakes. especially if I wasn't paying attention, right? Yeah, if it's yellow, if you're some people like anyone who used to live in like New Jersey, you gun it. Or probably in Philly too, right, Akil? Anywhere up there in the Northeast area, see that red light? Just gun it. I got to make it through. I don't care how long the yellow is. And I've noticed that the yellows are much longer over there. I live in Kansas now, but I grew up in the Northeast. Right? They're very long. Like, I wonder why they're so long. Oh, I know. Right? But second nature, you know exactly what to do. What do I see? What does it mean? What do I do? And then when you look at the chart, that's the exact process you need to have. Okay, so here's what you need. Let's wrap it up on this topic. Have a purpose, have commitment, have passion. You have to like trading. You have to know why you're doing it, your purpose, so you're committed to this. You have to like trading. You can't hate it, all right? You don't want to think that, I have to do all this work and stare at charts all these hours and make a trade plan and blah, 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 blah. Well, maybe trading is not your deal. It's not your jam. Have profitable skills. You do need to do some things correctly. Not everything is just up to you. There are really important skills that you got to have, and we've tried to discuss them with you this week. And then, of course, have a tested plan so you can believe in it, so you can trust it, so you can remain consistent with it, which will get your emotions under control. And you'll be able to release this ball and chain on you that is preventing you, all these things that are preventing you from being successful. The traffic light is just a suggestion, says Chris. Funny. All right, key number 1, that's how you create a backtested profitable trade plan without wasting years of your life. Make sense? Everybody good with that one? Now, one thing I want to do real quick is go to a chart. I had one open, but can't seem to find it now. Well, maybe I won't go to a chart. Yeah, don't have it. Never mind. Won't go to a chart. It's not open. I was going to show you some, but it's okay. We don't need to see it. Key number 2. How to make more profits by being wrong more than you're right. Now, we briefly touched on these other concepts, but the other stuff was, like a lot of review, right? I wanted to try and remember what we've done. Where have we been on this journey throughout this week? That was key number 1. Key number 2, we're going to get more into this. How to make more profits by being wrong more than you're right. And you're probably thinking, even if I could make a backtested profitable trade plan, Charles, I could never make one that was right enough, which means high win rate, and so I'll never be able to be successful. And you're probably thinking, successful traders don't really lose trades very often, do they? I can't be profitable unless I have a high win rate. I must be right to be profitable. No? Now I'm going to blow your mind. I'm going to show you how you can be wrong more than you're right and make more profits. Imagine that, making more profits by being wrong. Crazy. All right, first, what we need to do is discuss risk-reward profile, win rates, and all this stuff that goes into this. I want to make sure everybody understands this before we move on, because it's not going to make any sense unless you do. What's a win rate? Now, if some of you are like, what? We're going to cover that. Yes, we are, because there's some newbies in here, and that's the point of these events. Okay, so bear with me, those of you who are like, this is a bore. The percentage you are correct to your at least first in-profit target, whether you're trading single or multiple target positions. Usually the idea is that your first target, if you're trading multi, or even if it's just, I get one target and I have one stop loss, like we discussed, a single target, and that's it. No matter what you do, in most cases, we're going to be calculating that first target, because after that, we're probably going to manage the trade if we're trading multiple positions or multi-target trades. So the win rate is how many times do you hit that? 10%, 20%, 50%, 70%, 80%. What is it? Okay, very simple. That's what win rate is. Now we need to talk about leverage. And again, I told you before that risk-reward profiles and all of that stuff are different in leverage markets. Now let's talk about non-leverage markets so everyone understands. It's like stocks, right? One tick in that market is 0.01 decimal, which is 1 cent, which is the same in dollars, right? As you can see, that's exactly a 1-to-1 correlation. There's a 1-to-1 relationship there. There is no leverage on the instruments themselves. Simple enough. We get it. Now, leverage markets like Forex or futures, they're different. Now, in Forex, depending on the pair, 1 pip or tick, pip and tick are exact same. You can interchange that term, doesn't matter. For a micro lot, there's different position sizes. There's typically 3 standardized position sizes that any broker may give you. Some don't do micro, some only do minis and standards. It varies. Some don't let you do extra numbers after this, after the decimal. Like, I want 10,000 units is a micro, right? Sorry, 1,000 units is a micro, 10,000 units is a mini, 100,000 units is a standard. Some don't let you only do zeros after everything, right? Some don't. Some let you put whatever number you want. But the idea is that 1 pip or tick cost is, for micro lots, that's 1,000 units worth of the currency you're trading is 10 cents. For minis, it's $1, and for standard lots, it's $10. Okay, simple enough. Total cost per pip values vary by position size, which is what I just said. Now, FX leverage examples. We can have 1 to 10, 1 to 20, 1 to 50, 1 to 100, 1 to 200. There's probably some others, maybe 300, who knows. Now, it depends on your country. Every country has different laws. I think in the US, it's only 1 to 20 now. Other countries, you don't have any rules, and it's like 1 to a bajillion. No, just kidding. It's like 1 to 100, 1 to 200 maybe. What does that mean? This is important. What does it mean? Well, the higher the leverage ratio, like 1 to 100 versus 1 to 20, the less cash they will take out of your account temporarily for a trade. US is 150? Okay. I couldn't remember. I thought it was going to be 120s. Maybe they didn't do that. They said they were going to. Who knows? Anyway, doesn't matter. Point is, the higher the leverage, the less cash they will tie up out of your account for every trade you take. It is based on position size as well. The amount of money they take, cash, tie up, I call it, or the margin required, that's your margin amount, for the trades you take is going to be less. Take less money out of your account for any specific of the 3 position sizes that you use. So some brokers will offer you this high margin requirement, like high leverage, basically, right? 1 to 100. Oh, that means I need less money, so I'm going to trade standard lots and only have a $500 trading account. I'm sorry, you what? Don't do that. No, bad. No, don't do that. They trade standard lots, take 1 trade, gone. Because 1 pip per tick is $10. Every single decimal place change, depending on which pair you're trading, right? If it's 2 decimals for a yen, 4 decimals for any other. Forget micro pips. Hate them. Dumbest thing they ever did. I know why they did it. Still don't like them. Right? So you shouldn't do that because you only have $500. Why would you? And that's only 1 tick is $10. One. What if you have a 10 pip stop or a 20 pip stop? You only have a $500 trading account. You take 1 trade, you're done. Okay? You're off the table. No more chips to play. That's it. So don't do stupid stuff like that. All right. So moving on then. So how does risk reward work in leverage markets like Forex? Well, the risk in our case is going to be the amount of pips or ticks if you're trading futures to your initial stop loss. This is where you're going to get out if you're wrong, right? That's what a stop loss is. That's your risk. Okay. What's your reward? The amount of pips or ticks to your first in profit target. If you're trading multiple targets or even just one, it's that first target typically. What's that reward amount? This is where you're going to get out if you're right. Okay. Everyone gets that. The ratio is obviously the relationship between the two, the comparison between risk and reward. For example, now this is why this matters. In non-leveraged market, it's going to be the dollars that you're trading in your account. In Forex, not so. So let's say we have 10 pips of risk with 20 pips of reward. As an example, our risk-reward ratio is 1 to 2. We're risking 1, so that's 10. 10 times 2 is 20. That's our risk-reward profile. Give me yes if everyone understands this slide. We need to understand this. I will spend more time if I have to. Please let me know. Okay, we have to understand this before I move on, or it doesn't make sense. But you need to understand this is why I say, well, I made 20 pips on that trade, everybody. And they're like, why don't you talk about dollars? Because it doesn't matter, right? Oh, I hated those comments. Hate them, right? Why don't you show us in dollars? Now, percentages would be okay. That's fine, I guess, because it's ambiguous to the trader, right? The point is that it depends what position size you trade. Who cares? My 10 pips is not your 10 pips, right? If you're trading a $1,000 account and someone else is trading a $50,000 account, are your 10 pips going to be the same? Trading different lot sizes? No. So it doesn't matter, okay? The most important thing, like I said, is your pips that you can pull from the market. When a leverage market like this, you have to be able to take pips out over time, on average, successfully and be profitable, okay? So the risk reward then is independent of position size, all right? Makes sense? Risk reward is independent of the position size you put on. Now the cost is different, we know that, but the risk reward itself when you set up the trade is going to be independent of the position size or the money management that you use, all right? Now if you're still having trouble with this, just go ahead and watch the recording. I think we spent enough time. Now we've seen this graphic, right? Risk reward and win rate work together, right? We saw this graphic. Jason showed it to you twice now. He's stealing my thunder all over the place, right? Hopefully you guys can see my arrow. Again, we talked about that middle quadrant being the most ideal and most probable place that you'll find yourself. But we can see as risk reward increases, I can be profitable, let's say 1 to 3, around 33% or anywhere between 33 and 50%. Below there, okay, maybe, but that's going to be a really hard sell psychologically, right? At 50%, 1 to 3, well, you're a rock star, even at 1 to 2. Okay, keep all that in mind. Let's move on. I'm going to go to a spreadsheet. This is a spreadsheet I created just for this purposes of showing you guys how this works. You zoom out a bit, see everything. Okay. Now, over here, we have the win percentage, right? That's our win rate. Then we have risk reward numbers here, 1-to-1 right now. Now, we're basing this on 100 trades. Why? Well, that's a typical number we like to tell traders to backtest with, okay? To backtest on 100 trades, every signal or method that you have, if it's one method and way that you get in the market, you're going to want 100 trades of that on every single market in the portfolio that you want. Now, you may find out that that doesn't work in a certain market. Well, I guess you won't trade that market. Go find another one. So if it's $0 and you got one method of entering the market, that's 100 trades in that pair. Is it profitable? Yes or no? Now, depending on the time frame, that could be multiple years worth of historical data on swing trading, for example, or higher time frame trading. Lower time frame, you're going to be able to get to that 100 trades a lot quicker, maybe a month or two, maybe 3, depending on what you're doing. Swing trading, you're going to need multiple years in order to get that baseline number. Now, you could do more than that, just kind of the recommendation that we give. Okay, that's why it's 100 trades. Now, we're going to base this off 10 average loss. Average win is 10 because we're multiplying it by 1, but we're going to start with 10 so the numbers are easy. This could easily be 20, 25, 23, 41, I don't know, right? Could be anything. Focus on the ratios, okay? And of course, we have our win at 10, our gross loss is minus 500, and gross profit 500, again, based on the 100 trades, based on our win percentage and the current risk-reward ratio. Of course, our net is 0, because just like the graphic we saw, it's break even. We have the wonderful graphs down here to help you understand what it looks like. And then, of course, our net profits. And of course, these are just examples, but you're going to get the idea. So let's start off with 80% risk reward at 80% win rate at a 1-to-1 risk reward. Well, all right, here we go. Based on 100 trades, I'm risking 1 to make 1. So let's say it's 10 to 10 or 20 to 20 or 43 to 43 on one trade, and then it's 25 to 25 on another. Maybe my stop placement is dynamic, so the number changes. But I know that my ratio needs to be this. My win rate's 80%. My risk-reward ratio is 1-to-1. That's what I tested, so that's what I do. Again, the numbers could be anything. Focus on the ratios. Now, it's doing great. We're making 800. Our gross loss is 20 based on the win percentage at a risk 1 to make 1. We're netting 600 pips. Everybody, makes sense, right? Pretty easy. Okay, follow me here. Let's drop down to 65% at a 1-to-1. Okay, still profitable. Now let me just, so we had what, 600 pips? Right, so 65%. Now let's change our risk reward. We were at 600 pips at 80% at a 1-to-1. We're now at a win rate of 65%. This is closer to that middle quadrant on the graphic that we looked at. We're going to change our risk reward to 1-to-2. So the win percentage is right in that kind of middle area. How many net profit in pips? 950. Look at that. 950. Okay, 950. We're grossing 1,300. We're positively. We're negative gross is 350 pips. Do the math. Net 950. Is 950 bigger than 600? Answer in the chat, please. Is 950 bigger than 600? Now, 80% win rate. You think that might be hard to achieve? That might be in the unicorn section? Yeah, it might be. How many traders want to be right? We talked about this way in the beginning of the presentation, right? Way in the beginning. They want to be right. Oh, I'm not going to make any money if I'm not right. 2 plus 2 is always 4, and I have to get the right answer because that's how tests work. And that's the way I was trained to do everything. But trading is not like that. So I'm actually wrong more than I'm right. 65% win rate. Wrong more than I'm right. However, my reward is 2 times my risk. I'm making more net profit in pips. Okay? All right, now stay with me. We went from 600 to 950. Now let's go to 40% win rate. Now, 40% means I don't have to be that right. At a 1-to-2, I'm still kind of profitable. Not too much. It's only 200 net profit. We went from 600 pips to 950 pips. And what if I could get a 1-to-4 risk reward? What if that's what I want to do? Well, I'm going to net 1,000. Question, is 1,000 bigger than 950? Is 1,000 bigger than 600? Yes. And we talked about how can I make more when I'm wrong? This is how. Give me a yes if your light bulbs have gone off in your head and you finally get what this means. Oh, that's why win rate and risk reward work together. It's not all about win rate. Ding, 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 right? Makes sense? This is so powerful. Do you know why? Because you don't have to be that good. You don't have to be that right. What if your analysis is like, yeah, it's mediocre, I'm pretty good. It's not that bad, right? It's pretty good, but I can't get it that right. I'm only like 50% trader or not even, Well, how do you do better? Look for opportunities that give better risk reward profiles. Okay? Cool, right? So you don't have to be that good. That's great. That's good. You don't have to be the superstar in order to be successful. You can be wrong more than you're right. You can not hit that first target that much, that often, and have good risk reward profiles and actually make more than the 80% we started with at a 1-to-1. 8%, that's the problem. 80%, right, was 600. So 1,000 versus 600, and I can actually be less right. In fact, 80% is kind of a unicorn. You probably won't get it, and you'll be frustrated saying, man, I'm never going to be successful if I don't get that 80% that Pip Daddy talked about on the forum. He's awesome. I stink. I give up. No, don't give up, because you don't have to be that good, and he's probably not that good either. He's just lying. Who knows? I don't know. Maybe he's right. But you don't have to be that good. You don't have to be that person. You can be just kind of even 50%, right? Flip a coin toss. That's pretty good, 50%. 1-to-1, we don't make much. What about 1-to-2? Well, here we go, 500 net pips. 1-to-3, hey, that's pretty good. Net 1,000. Cool? All right, everybody, that is how you make more profits by being wrong more than you're right. Who loved that section? Give me a yes if you loved it. Hope you did. Hope it makes sense now. Like, this is a balancing act. And how do you know what you're going to get? Well, it depends on your method, depends on your system, depends on lots of things. Okay, but you have to find your own way. Because maybe a 40% hit rate is going to hurt you psychologically, and I can't do that. I'll never be consistent with it, which is what we talked about. No matter what system or thing that you devise or you're quote unquote handed, if you don't believe in it, you'll never do it. If 40% hit rate or 30% is a psychological nightmare for you, even at a 1-to-4 risk reward profile, are you ever going to be successful with it? No. You're going to make mistakes. You're not going to trade when you're supposed to, right? And when you struggle, Emma says, right? Community to encourage you when you waver on the losses. That's good too. So you have to be able to do it and be comfortable with it. So it is a balancing act. You do have to find your own way and figure out what works for you. Maybe you're like, nope, I want to be like a 65% trader and a 1 to 1.25 or 1 to 1.5, something like that. And maybe that works for you and you're like 70% hit rate. What you'll find is that the higher the win rate, the smaller the gap between the risk reward ratios. Again, the higher the win rate, the smaller the gap between risk reward ratios until some point they actually become maybe inverted, which you can do if you have a high enough win rate. It's not so common, but you can do that. The lower the hit rate, the greater the risk reward gap, like 1 to 3, 1 to 4, and the wider that gets, the lower the hit rate. Okay, so that's how it works. All right, key number 3 is how to almost double your profits without changing your trading strategy. Okay, now you're probably thinking, well, Charles, even if I could make a backtested profitable trade plan, and even if that plan had a win rate and risk reward that worked for me, I could never make enough profit to make a difference with my small account. And so I'll never be able to be a successful trader. Most traders think you have to have a lot of money to make significant percent returns. Focus on percent now. All that matters is how much money I make, not the percent returns, said the newbie trader. Now I'm going to blow your mind, okay? I'm going to show you how you can almost double your profits without changing your trading strategy. Imagine that, making more profits, but not trading any differently. Now we're going to have to talk about money management and how this works, okay? So you guys will understand it. So again, you got the plan, the risk reward that works for you. Now, how do we take advantage of that? Even if I have a small account, how do I make more percent returns? Okay? Fixed position. Okay, what does that mean? Well, we pick a starting lot size. It's typically small in order to prove consistency. When we start out trading our live account the very first time, we got our plan, we got everything in place. Do not, I mean, you could, but I would recommend against it. I think we all would at Tier 1 to not start trading a money management strategy. Prove to yourself that you finally have this plan. At least prove to yourself that you can be consistent with it. Start with a small fixed lot size that doesn't do anything to your account. Even if you have a large account that you're going to put down, larger than most, maybe 5,000, 10,000 or more, just trade micro lots. I know it's like a few bucks here and there where you're actually winning or losing, all right? But the point is to be consistent. Do that for a few months, whatever, depending on how often you trade and your plan. Get consistent first. This is great for beginners. You don't have to worry about position sizing. And again, you get to establish confidence in your ability to execute the plan. What did we say about money management? It's the decorations on the cake, right? You have to be able to bake the cake first. You have to have the plan. You have to be consistent with it. You have to return pips or ticks out of the market for leverage markets before money management even matters. It will do nothing for you if you don't. So a commonly used one, we're going to talk about this first so everyone understands, is percent of account. How does this work? Pretty simple. You take a percentage of your current available capital, 1%, 2%, 3%, 5%, whatever you want to do. The more percent, the more aggressive, obviously. Now that's commonly used in stocks, but how do I use it in a leverage market? What we do is we take the pip risk, that's the cost of my trade. So if it's 10 pips and I'm trading mini lots, that's $1, that's $10, right? And that's my risk for my position size. Again, this is about position sizing, not the pips themselves. The pips and the ratios are what they are for your plan. Right? We're not changing those. What we're doing is adding on to that. And then we make sure that the total trade cost is less than the set percent of account risk. Make sense? Pretty simple. We take the total trade cost, that's $10. I need to make sure that whatever my current account balance is, that $10, the percent risk that I am choosing to use, 1%, 2%, whatever, that $10 is that or less. Okay, the $10 of risk for this trade, whatever the dollar amount is less than the percent of my account that I am willing to risk on this trade. Now, can it go all the way to zero? Yes, but that's probably not going to happen. Can I get slipped on my stop loss? Yes, that can happen. And that's why we don't want these percentages to be too big. The goal is to stay in the game, not lose the chips, right? You lose the chips, you're off the table. We have to stay in the game. So it's best to have smaller percentages so it doesn't affect your account too much. So this is great for large accounts though, right? People are most familiar with this method. Why is it great for large accounts? Well, 2% on a $1,000 account versus 2% on a $100,000 account, big difference. What's that allow you to do? Well, with the bigger account, you can trade larger position sizes. Larger position sizes lead to more profits in terms of money and not percentages necessarily, right? Same percentages, but more money in your pocket, more money for bills, more money to replace your income, more money to be a sustained professional trader, right? Earning your income from trading. Of course, with a larger account, this benefits the most. But if you have a small account, what do you do? And that's the point of this section. So what we're going to talk about is called ratioed money management. Now, there's lots of different ways to do money management in this way. There's a few different nuances and differences in the way that you can do it. So focus on the process of it. Don't focus on all the nuances. Well, can I do it this way? Can I do it that way? Just focus on the process, okay? And what are we trying to achieve here? What do we do? Well, a couple different ways to do it. The example I'm going to show you today is to use the percent of account as the base position size. So how do we establish the base amount that I want to risk? Well, we're going to use the percent of account method in my example today. Okay. Now I think our spreadsheet does it a tiny bit differently if I'm not mistaken, but it's basically the same idea. Again, there's 6 different ways from Sunday to do this. Just understand what we're trying to achieve. Then what we do, we have a base position size that gets set up somewhere, or we just set it ourselves manually. We do have that on our spreadsheet. Okay, you can set it manually, or you can use an automated kind of calculation method based on the number of pairs you've traded and all this. Okay, or you can just set one. Well, I want to use this, and you can do that. What we do is add or subtract lots traded based on the profit or loss percentages that we've achieved. What do I mean by that? Okay, I'm going to say it again. We add or subtract lots traded, right, to the position size based on the profit or loss that we achieve in our trading while we're trading, keeping track of our records, right, keeping track of our trades. We know how much percentage we've lost in the last week or over the last trade and so on. And then we add or subtract to that. Let's go see what it looks like in the spreadsheet. Here's another spreadsheet for you guys. Again, this is just for demo purposes, so don't get too excited. Find it here. Oh, that's not it. Where'd it go? It's confuzzled. Where is it? Oh, see, that's not it. Hang on a minute. Keeps. Oh, no, I don't want to save it. There you go. All right, so here's my. Everyone see the screen? Sorry, I had a little snafu. Everyone got this? There's a new Excel sheet on the screen with a big blue box. You want to see the big blue box? Okay. So what are we going to do? We're going to do exactly what we did before. This is just an example of a spreadsheet. Okay, you don't need it. It's just to show this example. I had to build this to do this. Now we're going to do something else in a minute, but for sake of example, here we are. Lot type, micro. Again, 3 different kinds. Micro, mini, standard. This will change depending on what I choose. Estimated pip value based on most pairs is going to be about 10 cents for micro lots. Pairs will differ depending on which ones you trade, so understand that. Some are less, some are 80 cents, right? or 0.8, 0.08, whatever, sorry. Right, they're different. So win ratio, we have that. Why is there no loss ratio? Well, what are we doing with the win ratio? We're multiplying it, correct? Multiplying it. So if I put this at 1, like in our beginning of example, we find that we're right around break even, basically. Right? Nothing happens. So we understand that. And my spreadsheet is having a hard time. Come on, spreadsheet. Oh, it's upset at me. Of course it wants to die during the presentation. Why wouldn't it? Why wouldn't it? All right, Excel. Sorry. Gotta get rid of you. Let me find it, traders. Hang on. I think I had too many things open. It wasn't happy. Here we go. Let's try it again. Always something. Murphy. Who invited that guy? Okay. So 1-to-1. There we go. All right, so we're right at 0. Why? Well, again, 50% win rate. Our loss is 1. Again, these are ratios, not pips, not dollars, just ratios of those things, the representations of those things. So it can be anything. We just have to focus on them, depending on what your account size is and all those things like we discussed. And at 50%, we're at break even. So let's go ahead and look at a 1-to-1, but at an 80% win rate. And for the win rate, I do have to hit my update button here. Here we go. Awesome. Total pips, 600. We remember that, right? Right down here. And then what we've got is a total fixed profit return of $61 or about 6%. Okay, about 6%. I'm going over today, but I'm the last guy, so I can do it. Now, again, based on the 100 trades, right? Based on the 100 trades. So pretty good, not bad, 6%. At an 80% win rate, again, probably a unicorn, but we're risking 1 to make 1. So that could be, again, 10 pips to 10 pips, 21, 21. Who knows? But let's look at some money management. Here is the percent risk. Now we're at 1%. I could change this, but 1 to 2% is usually a good place to begin. We would recommend really not going too much above there. Now your total percent profit of the account is, total dollar amount based on a percent of account is $794 and about a 79% return. Again, these are examples. Remember the disclaimer from the beginning. I cannot guarantee you will do this because you still need the profitable trade plan. But do you see how just a simple account percent risk, right? Percent of account, the most simplest one is actually way better than just trading over the course of 100 trades, the fixed position size of 1,000 units. Cool, right? Everybody get this? So you see how we're taking advantage of what? Of our money. We earn more from our profits and our returns, and we take advantage of those things. We take that percentage and it's getting bigger. The 1% is worth more. It's worth more. It's worth more. Oh, we start to lose. We have to scale back. That 1% is now less, now less. Like here in the middle of the curve. Hopefully you guys can see it. I can zoom in. In the middle of the curve, we kind of hit a bit of a sideways patch, right? So that 1% is going to get less as we have dips. Now, what did you notice about this curve? It's very, very straight, left to right. Anyone know why it's very straight? Based on, is it win percentage or risk reward? What do you think? Do you think this straightness of this curve is based on win percentage or risk reward? Write it in. Paul says high win rate. Lee says risk reward. All right, so keep that in mind. See you in a minute. Think about that if you're winning less, you're going to have more periods of losing. Okay? So we'll change it in a minute and you'll see. All right, so let's move this over. Now we have comparison of base position risk, same as the account percent risk that we did over here. Going to do the same thing to get our base size. And our risk delta. What's a delta, Charles? Well, a delta is the change. Delta is change, right? Probably remember that from math class back in the day. It's change. How much percent have we made? How much percent have we lost? And based on that, we're going to modify the amount of lots that we add, micro, mini, or standard, whatever our number is, whatever our type is, to our position sizes as we trade. You can do this on a weekly schedule, which is how we implemented it in our spreadsheet. You can do this on a trade-by-trade basis level, whatever you want to do. It's really up to you. The world's your oyster. But as you see here, we make more money, $12.90, and our percent return is 129%. Cool, right? Do you guys see how we're taking advantage of our profits? Every time we make 5%, what do? Here's the trade data. Every time we make 5%, we add lots. See the add lots column here? Add lots. We add to it. We add to it. And if we're losing, we subtract from it. Look here, 3.1. This is just for round numbers. So 3. Then we went down to 2. Why? We had a loser. See that? That's what we're doing. Okay? All right, so let's zoom out a bit. Too far. Let's go back to the table at the top. I'm going to cover this again. Not too far. I'm going to go over here. There we go. I want to cover the old stuff. The other stuff we don't need to look at. We don't look at the fixed. So let's go to our examples. We had a 65% and a 1 to 2. Update the win rate. Hang on a minute. Now, what do we notice about this curve? We start to see more dips, don't we? Start to see more dips in the equity. It's still pretty left to right, which is what we want to see. But we want to see more dips in the equity. Now, there was pretty split here in the room. We said win rate, risk reward was the reason. Well, win rate is less. Risk reward is a little higher. What if I went 1 to 1 and 65? Ooh, 1 to 1 risk reward. Same risk reward as before. Win rate is lower. So we can see that win rate affects this. Okay? Win rate affects the troughs, the peaks, the valleys in your trading. Can we offset that with more winnings? Yes. But as your percent decreases, and depending on your risk reward ratio, you're going to see more troughs, more valleys and peaks and so on, up and down. Now we can, again, smooth it out with higher risk reward ratios, but win percentage is going to have a major effect on that. But again, it's a balancing act. So what do you see here? Fixed 9% from 6, $94, 145% for percent of account, $1,450. Base position 1%, delta 5% on the ratioed method, $3,000, 300%. Crazy, right? Look how much more we're making by taking advantage of our winners and then scaling back when we have those losers. Does everybody understand what's happening here with the money management? Please give me a yes. If not, please say no. I want to make sure we get it. We'll go through the next example here, the 3 that we did. Right? So what we're doing is taking advantage of our winnings and trying to limit our losses. Are we changing our trading? No, the only thing I'm changing is what our trading plan is. Is our trading plan have an average win rate of 80, 65, or 40? And was the risk reward 1 to 1, 1 to 2, and 1 to 4? Okay. So let's go up to the last example was 1 to 4 and a 40% win rate. We see that the risk reward smooths out a bit. Let's update our win rate here. Okay. Again, look at more peaks and valleys. You guys see that? Now it's still left to right. It's a bit more parabolic. Okay, but we see all the more peaks and valleys. Again, win percentage is lower. What does that mean? You have more periods of losing. You have more times where you don't win, right? You lose 60% of the time, but you win 40% of the time. Okay. Great question, Jane. Hang on to that thought. Okay. So what do we see here? Account percent risk, $1,500, 151%. Everything just keeps going up. Now our ratioed method, 3,200, a little bit more, and 321%. Okay, we still see it's far better than percent of account, and percent of account is far better than the fixed method. But again, they all have their place. You might go from fixed to start, then do percent of account, and then when you feel really good about being consistent with that and the money management side of things, that you'll have more movement in your equity curve, depending on what numbers you choose, then maybe you move to something a little bit more aggressive, like the ratio management method. Again, this is about, if you have a small account, how can we take advantage of it in a little bit more aggressive way, but still having the room to change how much we want to risk. Now, if you want to be more aggressive, make this delta a lower number, 3%. Notice we went from 300, so 321% from 5 down to 3, 486%. Don't focus on the money necessarily, focus on the percentages. Okay? There was a question, how do we do the delta method? Well, the delta is about what percent of your account have you returned profitably or negatively, then what will you do with your position size? If we're winning more, 3%, 6%, 9%, as it continues to go up, we're going to add more lots to that base position amount, or we might recalculate the base. Again, it doesn't matter. It's kind of tomato, tomato. Either way basically works. The point is, what we're doing is adding to our position size as we're doing what? Winning. We start to have a period of losers. That drawdown hits. Look at this big valley here. This big valley right here on the ratioed one. That's also present on the percent of account. And it gets more prominent on the one that's more aggressive in terms of position size changes naturally. But this trough, this is a period of losing. That's a drawdown, right? It's $2,900 of drawdown. But we've made it less because as that starts to happen, we're going to decrease our position size appropriately. Why? We're not winning. Why would we increase our position size if we're losing? You don't want to do that. Yes, the more riskier you go, the more volatile everything is. So if you want to get more conservative, oops, other way, zoom in a little bit. We can go up to like 10%, and we'll see that we'll still outperform the percent of account, which is 1% only. A risk to delta of 10%, higher number, more conservative. So it's less was 300 I think before, now it's $2,200. Okay, more conservative. Still more aggressive than percent of accounts. We're taking advantage of those winners. And again, the idea is to be able to take advantage of that small account. Does everybody understand what we did here and the basics of how this works? Don't focus too much on the formula necessarily, but do you understand what we were doing? Because you could recreate this on your own. I know you don't have to recreate what I did. This is complicated. Plus with the buttons, don't worry about that. What I'm saying is you can recreate the method in Excel if you have a decent knowledge of Excel. Okay? My goal is to show you how this works so you understand. And again, I would stair step it. Take your time. Fix first, maybe percent of account, and then when you feel really good, decide on a risk delta that you want. It's really risk reward delta. You could just call this delta, but I was looking at it from a perspective of conserving capital, which is what we want to do. And you could, put this number higher, change it, whatever. All right? Cool beans. All right, that's how you almost double your profits without changing your strategy. I actually think we did double them if I'm not mistaken. Cool, everyone got it? Everyone understand how money management works? How it's the icing on the cake? I know I've gone long. I've been like an hour and 20 minutes. This is important stuff. Okay, this is how you put it all together. Awesome. Very good, very good. Now, Jane had a very important question in the chat. You going to be sharing something with us? Who wants to have a sneak peek at the Tier 1 spreadsheet? Who wants to see it? All right. Hang on a minute. I got to close my other spreadsheet so I don't blow everything up like last time. No, I don't want to save. Let me go find it. Here we go. Now mine was just an example to kind of demonstrate how this works because I wouldn't want to test all the different trade data. I need a strategy that gets 80%, 65%, and 40%. I just wanted to show it. Okay, I wanted to demonstrate it, and that's why I had that thing. This is our spreadsheet. Now you can see that it's populated with data. Okay, these are actual trades that were tested. Okay, you guys can see all the data here. This is the trade log. This is the backtesting trade log. This is where you will put in all the trades. You can see we have all the required information that we need, that we want to know. Entry date, entry time, pair. What chart am I trading on? I have multi-charts, or I have different entry charts that I do. I have a higher time frame and a trading time frame. What method am I trading? Different patterns here. Okay, different patterns. Maybe I have some ATR that I need to know about. Maybe there's a type of entry that this needs to be. If I know what these are, it's okay. It's not a big deal. Depending on, if it's a pattern, well, it's a pattern. That's the type of entry. Maybe you have different entries. You might have a scoring mechanism that you use. We have our entry price, stop losses, target 1, target 2, and if you're trading a target 3, close dates and times, position exits, which are important for our pips amount, and then the spreadsheet totals it all for you. You can see all the net pips, just like we saw in my examples, the current account equity that you are working with. Okay, we'll see that in a minute. What's your gross win? Okay, gross loss in dollars. How many lots per target are you trading? I'm going to see how money management works when we do units here in a minute. I want to blow your mind. It'll hurt, but you just understand what's going on. Also, average wins, which are very important. If we have a lower win rate, look at this, 53%. Oops, sorry. 53% here in blue, right? Lower win rate, but our average win is what? Greater than our average loss. Want to see that? Average loss and average win are basically like a risk-reward mechanism. Now, it's not exactly the risk-reward on your trade, but it's a representation of the same idea. What did we know? Well, if this was 50 and 50 at 53%, we might struggle to be profitable. But we're at about 53%, but our average win, you can see, is not a 1 to 2 or anything like that, but it's more than 1 of our average loss. It's by 1 to 1.25 maybe, or 3.5, something like that. So after all of our trading, we see that our average win, average loss ratio just like our risk reward ratio along with a win percentage gives us a winning method or winning methods if we're trading multiple strategies here. We can also log errors if we had any errors made with your back testing. So it could be possible if you go back and review, although probably more of a real-time thing. And of course, we can see our closed profit. Now, we can also see the graph here, but I'm going to go to the money management tab, and we can see the different representations of doing different things. Fixed size versus money management. Now, what you're going to see is that these are basically the same look, right? Basically the same look, okay? But we need to change some things. Now, money management profit trigger, we have a dollar amount in here. If you lower this, what are we going to do? Remember, lower numbers, this is like the delta. This is your delta here. It's just not a percentage, it's a money amount. We lower the number, more aggressive. Okay, see that equity curve ticked up. The accelerator. This is how aggressive money management lots will add to your base position size that we're working with, just like we talked about when we were looking at the example. Smaller is more conservative. If I want to go bigger, I can do that. I can go to 2. Now we went from about the same at 14,000 or 15. We're up at about $20,000 on these strategies that we tested. We have our starting account equity here. On the back testing tab, we see our total equity on the left, right here at the end of everything. Okay, but we started with 10, and we have some drawdown numbers here. What does this mean? Well, if we do something different, like I don't want 25, I want it to be 20 or 15. I'm trying to get a certain thing to happen here. Give me a second. Oh, our max drawdown is hit. Our max acceptable drawdown, not over a week, but overall was 11, and the spreadsheet tells us that. So what does that mean? Well, that means you, trader, Joe, Susie, are going to have to accept at least 11%. You're going to have to accept that if you want to trade what you have. Scratch trades, Vincent's, are break even. Like, I move stops. It depends on the strategy whether you'll have like a break even trade. Usually you'll probably just be positive or negative. Depends on your trading method. Right, but I have to accept this, right? I have to accept 11% at a minimum if I want to trade this. So I'll always put up to 15. Good to go. All right, so I know that it's about 11, and you can mess with this number. Weekly drawdown, I have 10%. So in 1 week, I might lose 10%. Now, our spreadsheet is based on a weekly rotating recalculation. So every week, you can reevaluate your position size. You could do a daily. Ours is set up for weekly. Oh, our max weekly is 6. So I realized, man, I'm going to have to accept 6% in a weekly drawdown. So 5%, if that's what I really wanted, this wouldn't work. So maybe we go to 8 or 10. And our lot size currently is mini. And a standard on a $10,000 account, that's acceptable. What must you understand about these percentages? This is estimation. Money management is estimation. There are a lot of things that go into the money management side of things when you're actually trading. There's a lot of things going on. There's margin and cash tie up in your account, which we discussed. That leaves only so much money available for fluctuations in position sizes. That's why you have to trade percentages smaller, because if you don't, this is what happened to me. I first started trading and I couldn't trade anymore. I had to stop because I had too much drawdown and didn't have any more money. That was my fault. I didn't have enough money really. I was undercapitalized and I had made mistakes that made it worse, right? But you won't have enough money. So you have to make sure that you can handle the drawdowns, and that you also are going to be, not making this too big and going crazy. It's all estimations, but you have an idea of what you need to do. We can also change the manual start size to yes, mine is 1. We can go to no, and it'll auto-calculate like we discussed and do something different. Now we can see that our percentage for the probably the week is too low. Oops. No, overall. So our starting size is too high for our acceleration and everything that we're doing here, depending on what you want to do. If that doesn't work, you can go to yes, and you can make this 1, 2, 3, something that works for you to start from. Cool. Now, moving on to the backtesting spreadsheet. The data part of the spreadsheet. Need to bring up my field list. All right. What I want to do, I want to show you how to use the report. So we got all the backtesting data. It's got all that stuff in there. And this is the backtesting portion. We also have 3 tabs that have to do with live trading, keeping track, and then doing your money management. So let's just be the last thing. I'm at 1 hour and 30 minutes. Hang in there, guys. We're gonna get there. So what we're gonna look for is the. I want to show you how to build this. Trade number. I'm gonna put all the trades here. Rows. There they are. And I'm gonna do total closed pips for the trade in values. This says count, so I need to change it to sum. Cool. Now that gives me all of the pips returned for every single trade right there in the report. And what I'm going to do I'm going to copy all this. I'm going to show you. What you can do is grab this, copy, go back up. I'm going to paste it over here somewhere, paste values. There's all my values. I want to make sure that these are numbers with a accounting style for negative. Here we go. Cool. Now what I'm going to do, I'm going to do a quick sum. I'm going to add this to that. Boom, this is going to give me a rolling balance of pip equity. This is pip equity, not the dollars, because the dollars are in our spreadsheet. Already it does it for us. I don't need to see that. I already know what it is, but now I can insert a graph line. Check it's not quite right. Must have something missing. Well, I think I've done it wrong, but you can do this. I did it the other day. Of course, I don't know how to do it during the presentation. How convenient, isn't it though? It's always like that. Anyway, you can see that this goes up over time. What I really wanted to highlight was this. Let's go back to the curve right here. Anyway, that's how you do the report. So pretty cool. You can do all kinds of reports. You can do time, months, days, time of day, day of week, all that, and you can see what's profitable. What I want to focus on for the end of our session, okay, is the part right here. We can see that this is a lot of sideways. We go sideways. What's our period? 2019 to 2020. For the majority of 2019, we went sideways. Think about this. Whatever I'm going to trade, I have to be able to suffer a certain amount of pain in order to achieve the reward that my plan says it's going to give me. I have to be able to accept the pain because it's going to happen. You're going to have drawdowns. You're going to have periods where you lose. This is very important. Okay, if you cannot stomach what you've got, you might need to change something. Or what you can do is change your mindset, change your mentality, so that way you can do it. But you have to be able to accept this, because if you're going to trade for half a year or whatever it is, or almost the whole year and kind of go sideways, and this is swing trading, so that's why it's taking a long time for these things to play out. You could maybe add more to your portfolio to balance it out. Maybe you can't, and this is the best you could do. You may start your trading right here at the beginning, like this was, and go sideways. Or maybe you'll start in a drawdown before you go back up. Okay? That is something you must understand. Okay? You gotta understand that. Because if you don't, it's going to be very, very hard for you to be a trader. You have to be able to accept whatever the pain is that system is going to give you in order to get to the result that you want. Does everyone understand that? This is a psychological thing, because it's easy to feel good when you're winning, but when you're losing, man, it hurts. Again, the emotions don't go away, but you have to deal with them. And this is how you do it. You backtest, you look at your numbers, you look at the data, and you understand what it means to you and what you're going to have to prepare for psychologically. So let's wrap it up, traders. Did I deliver on my goal? Do you now believe that backtested profitable trade plans are the key to consistent returns in Forex? By now, after my presentation in the last 2 days, this must be a big, big yes, or any market for that matter. This is how it's done. So let me ask you this. If you were able to create a backtested profitable trade plan like we discussed in Key 1, then you set up a risk reward and win rate as part of that plan, you could execute consistently like we discussed in Key 2, and then you set up a ratio money management or any money management strategy that fit your risk tolerance like in Key number 3. Do you think you could be successful? Give me a yes in the chat if you think you could be successful. Awesome, lots of yeses. Yeah, I mean, this is how it's done. I hope you're excited about what you learned, but maybe some of you are still overwhelmed. You're like, well, I got to do all this stuff. I got to learn how to read a price chart like we were doing earlier in the week. I got to write a plan like we went over the other day and like Charles just did. And then I got to figure out, risk reward, a win percentage. I got to learn to read a price chart. I got to do money management after that. Oh, right. That's okay. It's not your fault. I couldn't show you everything anyway. We couldn't even show you everything this week. We're literally scratching the surface. Okay? But it's okay, because that's why you're here. At this event, everyone, I repeat, everyone starts somewhere. All of you start somewhere. Okay? You all start somewhere. Don't be discouraged by the fact that that's too hard. Then this is not for you. You got to get over that. Yeah, it's hard. Most things that are worth having in life are difficult. It's the easy stuff that's usually not that worth it. Okay? Remember, here's the 3 keys we covered today, just to recap. How to create a backtested profitable trade plan without wasting years of your life. That's our master key. This is everything that your trading hinges upon. And inside of that, we looked at how to make more profits by being wrong more than you're right, which was risk-reward ratio in terms of a leverage market like Forex or futures, and how to almost double your profits without changing your trading strategy. Again, part of the trade plan, that will be the money management method that you decide to employ. So here's what we've done. These keys, these are the what. Okay? This is the what you need to do. I did show you somehow, but everything else really is the how. This is the most of the week. Traders, this is the what. This is what you must do. And we show you some how, but we don't have time to show you all the how because it's only 1 week. So interview, the 90% path to failure looks like this. We all start out somewhere. And at the beginning, we start out with success. But over time, bad things happen. We try a system and strategy. We think we're going to trade it, and it doesn't go well. And we try again something else over time, more free training. Then we trade that thing that we learned. It didn't go well. We try another strategy, another system. We trade that. That didn't go well. And all we're left with over time is frustration, failure, wasted time, and lost money, all of which are completely avoidable, right? We talked about the commitment equation. We talked about the free content trap. We talked about the real money myth and not needing to put money down in order to learn to trade. The difference is, now look at this curve going top left to bottom right, not good. Your tier 1 path to success, which we have discussed today and throughout this week, looks like this. Most of you are starting out at failure at this moment in time. Some of you are not. You're brand new, which is great too. That means you don't have to do these mistakes. Some traders, you've been at this for 5 years, 10 years maybe, or just some weeks, some months, a couple years, whatever. We start over. Today you start over. This week you start over. You learn profitable skills. Then we train and practice those skills. We get our questions answered, and we probably get some mentorship from people who know what they're doing. Then we practice and fix our mental issues or more technical issues, whatever it is. We then test that trade plan that we develop. That's ours. We believe in it. We created it based on the basic fundamental things that we've learned. But it's mine, and I believe in it. Then I create a money management schedule that I'm going to employ live. Then I trade. Anyone see the difference here? Anyone see the difference? Yeah, big difference, right? When did we trade? At the end. We did everything first. We prepared first. If you're not preparing, you are preparing to fail. So how do you become a successful trader? We've talked about it. There's a current you, Jason talked about it, who is consistently unprofitable at this moment in time. Whether you have been trading and are unsuccessful or whether you are brand new, either case, both of you are consistently unprofitable. But there's a future you that is consistently profitable. How do you get across? How do you bridge the gap? You have a transformation. That's how. That's exactly what this entire week, this entire event, and my entire presentation, to try and help sum this up before we get into the last day tomorrow, is about. Oops. We lose the screen. That's weird. Not sure why. You guys got the screen back? Sorry, I don't know what happened. Cool, okay. So, don't know what happened. All right. So, this is the path to success, right? We've gone to extreme detail on some of these concepts, but like I said, we didn't have time to cover everything. This is the path that we take all of our clients down inside of Tier 1, and that's literally what we've tried to show you in a high-level view throughout the week so you can understand how this works. This is the transformation you need, right? This is the process. You want to get from point A, where you're consistently unprofitable, to the end of the road, which is consistently profitable, a different you. You need a transformation, and that's what this process is about. There is no coincidence that the 10% success path, right? Not the 90%, the 10% has an upward trending curve and the 90 didn't. That's on purpose because of what those actions are will lead you to that result. And depending on what you decide to do, that's the end result you're going to get. So how many of you would prefer this curve and have a transformation instead? Give me a yes. We'll finish the presentation up here. Let me know that you are committed to doing this. Okay? It's all about you guys. This is how you do it. Awesome. All right, traders. Well, that is my presentation. That's going to be it for the day. I hope this was valuable to you. I hope that the week so far has been valuable to you. And today's giveaway, we're going to pick somebody at random who's been here live, is the spreadsheet. I said I would show it to you. Some lucky trader is going to win that spreadsheet today. We've been giving away stuff all week. For those of you watching the recording, We gave away VS1 on Monday. We gave away the Daily Chore software yesterday. And today we're giving away the spreadsheet. So make sure you also come back tomorrow for day number 4. We'll be giving away another awesome piece of software that you guys are going to love. And we'll see you all tomorrow. All right, glad you guys enjoyed it. Take care.